Hello everyone. In this video, we're going to be going through the topics of the LIFO retail method and then the dollar value LIFO retail method. So this is kind of concluding our discussion on the retail inventory method. These last two topics, again, as I said in some of the previous videos, if you haven't seen the videos on the basics of the retail inventory method and also the video of the LCM and the cost methods for the retail inventory method, you're going to want to go ahead and go back and watch those before you actually go through this video, because otherwise this video is going to be somewhat hard to understand, because there are certain concepts inherent that just build up to each other that, you know, if I spend each video re-explaining the other concepts, each video is going to be like over 30, like probably 30 minutes long, and trying to keep them a little as condensed as we possibly can. Okay, so make sure you've watched those videos before we go through these. So let's just go through them. The LIFO retail method, companies that adopt this retail inventory method do so because of the tax advantages inherent within LIFO. LIFO just has tax advantages because, you know, if you're selling the most recent inventory method, most recent inventory that you've sold, that would mean that you're selling in a time of inflating prices, you're selling the most costly inventory, which means that if you're selling the most costly inventory, then compared to something like FIFO, right, that's selling the inventories that are sold first, those are going to sell the least expensive inventories, okay? LIFO is actually going to sell the more costly inventory, which is going to reduce your income, which is going to reduce your taxes, okay? Then both markups and markdowns are included in the cost to retail ratio. Both are above the line. Again, watching the other videos in tandem should make sense what this means. In tandem with this statement, it uses the concept of LIFO layers and looks for increases or decreases in inventory from year to year. LIFO layers was introduced in some previous topics, and so you know, we went over that extensively. What is a LIFO layer in another video? So basically, we're looking for increases or decreases in LIFO layers, which are just these layers that we build up each year with the LIFO method. This method assumes that markups and markdowns only apply to purchases of the current period and not to beginning inventory. So we must keep beginning inventory separate from everything that happens during the year. This method also assumes that selling prices are stable and not changing over time, which again, probably not the most reasonable assumption, but that's the one that if we're told to use the LIFO retail method, that's what we do. It makes our life a little bit easier than the dollar value LIFO retail method. And then also utilizes a separate cost to retail ratio for each LIFO layer. Okay, so basically meaning for each year that we have a LIFO layer, we have to have a separate cost to retail ratio. Okay. Dollar value LIFO retail method, everything about this method is the same as the one above, except this method assumes that the selling prices of inventory are not stable and are changing over time. It makes things much more complex, and it's basically dollar value LIFO, but more fun, depending on what your definition of fun is. Okay, so the main difference from LIFO retail method is that this method has a price index for each year in addition to the cost to retail ratio. So these calculations and this whole, you know, these two topics are kind of complex. They're not terrible. If you've seen them, if you've seen the other videos first, you'll have a pretty decent background in what the retail inventory method is in general. But make sure you've watched those, like I've said. But we're just going to dive into some problems so that way we can sort of just see what's going on with these problems, okay? So first we have ABC. This is the LIFO retail method first. ABC company is a retailing concern that sells a myriad of different items. The company uses the LIFO retail inventory method to account for its cost of goods sold and the value of its ending inventory. As of December 31, 2017, the company has the following information available related to its inventory. Then we're given a bunch of items. We're given their costs, and then we're given the retail value of the items. And then it says, prepare a schedule to determine XYZ company's ending inventory and cost of goods sold for the year ended December 31, 2017 using the LIFO retail inventory method. Okay, so now what we're going to do is that we're just going to try to get both of these pages on to be showing at once. Let's just make sure that we can see everything. Okay, it looks pretty good. Okay, so now what we're going to do is that we're just going to go through the LIFO retail method chart, and then we have one more page with the actual calculations to get the cost of the inventory. Okay. So a lot of these numbers are similar to the ones in the other video for the LCM or the conventional method and the cost methods. Okay, these numbers, a lot of them are literally the same. I think a few of them changed, but most of them are the same. So what's going to happen is that this actual page because we went over extensively in the other videos, I'm not going to spend a ton of time on each individual one. We'll highlight a few things here and there, but the next page is where the actual differences come up between LIFO retail method and some of the other methods like cost or conventional. And so we'll spend the bulk of our time there because that's the hardest part, okay? One thing to note here, the first thing to note here is that we have beginning inventory and it is segregated from everything else. Okay, so what we do is that we have our own cost to retail ratio like we talked about on the previous page. We have our own cost to retail ratio for beginning inventory. Beginning inventory is given right here, 40 and 60 for cost and retail respectively. Okay, then we figured out our cost to retail ratio. That's basically the first thing we always want to do in LIFO retail problems. Okay, then what we do is we list out all of our purchases, freight in, everything at cost and retail, just like we do with our other methods, okay? So, you know, purchases, 100 and 180, okay, freight in at the bottom here, 5,000, purchase returns, 3,000 and 4,500, purchase discounts, 2,000, and then we have our markups, markup cancellations, abnormal spoilage, and then markdowns and markdown cancellations. As it says on the previous page, the first page, both markups and markdowns are included in the cost to retail ratio. Both are above the line, okay? Meaning that, again, both are above this line right here. These lines right here, this cost to retail ratio line, both markdowns and markups are included in that number, okay? So markups, 5,000, and then markup cancellations, 2,000, markdowns, 4,000, markdown cancellations, 1,000. And then abnormal spoilage, 4,000, then 6,500, okay? If we were to do the math, and again, when we're doing this math here, 106 and 178, okay, that only includes these items here and then these items here, okay? We're excluding beginning inventory. This is the major difference from, at least on this stage of the calculations, this is the major difference from something like the conventional or the cost retail inventory methods, okay? If you remember back to those, we literally just added everything up. We added up beginning inventory into this 106, okay? So we actually had 146 when we had that example, okay? But in this case, we have to keep these layers separate. So we're doing beginning inventory by itself, and then everything that happens during the year is kept by itself. Okay, so remember to do that. First, beginning inventory is by itself. Then we have goods available for sale for this year alone. Okay, this is goods available for sale for just this year, right? It does not include the beginning inventory. Technically, there is beginning inventory as well, but we need to exclude the beginning inventory. Okay, so we have two ratios, one from last year, one from this year. Okay, then again, we have sales revenue of 90,000, that's just given. Sales returns are 7,000 given to us, so we subtract away 83, and then we have some normal spoilage of 6,000, that's given right there. Again, this idea of the employee discounts and sales revenue being recorded at gross or net, we went over extensively in the first video, so we're not going to go over that here. We're just going to note that employee discounts are not taken out, and that is the correct treatment because sales revenue is recorded gross, and we always want to make sure we're subtracting out the gross sales revenue. Okay, so that's the first part of this question. The second part of this question is arguably, the harder part to understand, and so we're just going to spend a few minutes here. There's not many calculations, it's just we have to go through a couple conceptual ideas, and then we'll basically be done with this first problem, and then we have to go through one more problem. So now what we do is we take our ending inventory at retail, 89,000, we put it right here. Okay, so we're moving it to a new page because we're just running out of space on the page before. Okay, so now what we do is we say ending inventory at retail. Okay, what we want to do is we want to compare this ending inventory at retail to the beginning inventory at retail. Okay, and then we want to make a determination. Did inventory go up or did it go down? Okay, in this case, clearly inventory went up, right? Because we have a situation where we have $89,000 in our ending inventory. Okay, we have $89,000 in our ending inventory. All right, let's see. Let's make sure that that was correct. So we had 180, and then we had 4,500, and then we had, just give me 1 second. Check this over. Okay, and then we had, okay, $8,900 there. Let's see, 1 second.